Hi, everyone. Thank you for joining us today at the ReFinance Summit and today's panel on the DSCR. But we're actually going to focus more on small. We're going to be focusing on small to middle market loans, which will cover DSCR loans, rehab, fix and flip, bridge loans, and small construction. We're going to dive into meeting the panelists. I'm going to let Aaron go ahead and start us off with a little intro on him, and then we'll kind of go down the line.
Yeah, absolutely. Thank you for having us out here today. I'm with Logan Finance. I'm the Chief Operating Officer. We're a lender. We are trying to grow our what we call business purpose or commercial broker space tremendously. We'll lend on about $4.5 billion this year of true non-QM. Our focus is primarily on DSCR. At this time, we're not offering any RTL type transactions, but we do about 50% of our business is 1 to 8 DSCR business.
My name is Harris Lukashuk. First of all, I think we should let the crowd know that the panel is the zero interest loan panel. So maybe we'll get more people to attend rather than calling it DSCR. So zero interest loans. We'll see. My name is Harris Lukashuk. I work at Bayport Funding, where I run our multifamily middle market bridge lending space. Bayport Funding was formed about 15 years ago, primarily as a fix and flip, privately held, self-funded lender. And over the past few years, we've taken the DNA, the entrepreneurial DNA of fix and flip world, and applied it to the more institutional world of multifamily, so that we can kind of bring that same urgency, timing, hand-holding, and the in-house functioning for multifamily. And we are approximately about $250 million of origination, again, split between the 1 to 4, and then the middle market multifamily sized 5 to 40 units, $2 to $10 million. Thank you.
Courtney Newman's CEO of Asteris Lending. I would say we're probably the new kid on the block. We recently launched, backed by a private credit manager out of New York. We launched in September of last year. We're a direct lender, doing 1 to 4, your normal fix and flip, new construction, and then DSCR for 1 to 20 units as well.
Thank you, Courtney. So we're going to start by diving into with all of the ground-up construction, bridge loans, DSCR loans, we're going to talk on how brokers like yourself can utilize it to better support your investor base or grow your investor borrower bases. We're going to cut through the noise. We're going to get down to what lenders are looking at, guidelines, and really how real-world insight can help your investors grow. So,
Well, I'm going to have to pass to my peers here. As I said before, Logan is primarily focused on DSCR business, but it sounds like both of you do quite a bit of the construction, fix and flip, and other type of business. So I'll kind of lean on my peers here to talk about that.
I'll take it from the single-family standpoint for the 1 to 4 side. I think it's very good when you're looking for one on the construction side is we're heavily looking at the experience of the borrower. I think that is truly what the capital markets want to see when you're doing those type of loans, whether it's a general contractor or if it's that developer, that they have experience in what they're looking to do that loan on. And so for us, we look at a 3-year look back, a minimum of 2 successful completed flips or 2 successful completed new constructions to at least break into our space. For us, it's really risky, especially at this moment in time in the market that we're in, given the interest rate environment and what's been going on for the last 24 months to do newbie loans for people that have not done the construction side of the business, especially before. So when we look at it, it's the credit quality of that borrower, and then also understanding the story behind what that borrower wants to do, whether it's the different market, if they're into tertiary market, or if they're looking for $10 to $15 million exposure limit of saying, hey, I want to do 50 new construction loans in the community, and really understanding, hey, how are you capitalized? What is your track record to be able to complete something like that, and really go into those different nuances of the loan to really understand how we can help better serve them as a lender.
Yeah, and thank you. I'll speak about kind of where I think brokers can work with us on a product that is not typically, serviced by many in the market in this, I'll call it the $2 to $10 million space, or really maybe the $5 to $10 million space. I think traditionally, a lot of brokers have been hesitant to create flow based on that loan amount, just because it's conceived to be a similar amount of work as with a $10 to $20 million deal, and we figured you'd rather spend your time getting a bigger check at closing. That could all be true. I think the idea is that, at least from Bayport's perspective, because it's our own capital, we try to treat that $2 to $10 million deal like a debt fund would treat a $50 million deal, except different legal costs, different closing costs, of course. But we really do try to make it so that the broker doesn't really have to feel like they're skating uphill on every step along the way. So I think that model has incentivized brokers to bring us business, and then once we've done a deal, the developer has gone through our in-house draw process and has seen that he can call my colleague Deborah, who sits 10 feet from me, on a Wednesday and have the inspector out by Friday and funded Monday, and continually going through that throughout the process. They start becoming very comfortable with the product, and all of a sudden, we become their best friends, and the broker who brings it there is able to kind of take something off their list of things to do, having to follow up with the bank, who's sending it out to a third-party servicer. That becomes a very attractive feature. So we tend to get a lot of repeat business that appreciate that, and then since we ensure that the broker relationship with the client is sticky throughout the years, they can have a nice income stream from bringing us business for that particular developer. So I think that helps to incentivize the broader broker market to bring business in the kind of underserved middle market bridge lending space.
Thank you, Harris. On the market space, getting into kind of a construction loan or bridge loan, how would you recommend brokers break into that space if they haven't or their borrowers have not? So really finding a way to build the connection into ground-up construction.
Yeah, so I'll take your question. I'll change it a little bit to suit my answer. We have found that a lot of, really the genesis of the multifamily program for us and for other lenders in the fixed space has always been that they've been incubating their clients over the years, building a single family, then a two family, then a four family. And as they've been incubating that borrower, the borrower has gone out and has seen opportunities to do larger projects. And historically, either that particular lender would make best efforts to try to do that 20-unit project, and maybe not have the greatest success because maybe they're aggregating loans for sale, and the end loan buyers are not as comfortable with multifamily, or they were letting those developers leave their platform and go off into the world of the debt fund world. And a lot of times, number one, it's a disservice to the developer, who all of a sudden has to deal with a more institutionalized counterpart, either at a bank or at a debt fund. And also that lender has lost that ability to keep the client, and is kind of a victim of their own success of growing that client. So Bayport, and not just Bayport, other lenders like us, have endeavored to kind of incubate that developer over the years and build them up to the point where they can evolve into a multifamily developer. We had a particular example of a developer in Newark who was very active in building 2 to 4 unit buildings and had a great portfolio, and really knew what they were doing. They came to us for a 25 unit ground up deal, and if anybody was using a black box to kind of figure out yes or no, it'd probably be a pretty quick no for institutionalized type of lenders. So what we did, and this is instructional for brokers out there, and we did work with a broker who was very helpful. number one, we got to know the developer. We got to know his team. We walked all his properties, and parenthetically, I was able to convince my equity partners that these 3 adjacent 2 families were as big as the 25-unit deal, so same amount of stuff being built in the technical term. We got comfortable with his crew and with his in-house project management team that they knew what they were doing, and they came to us with a very complete package of approvals, a really good budget, just so it took away the other X factor. So I would say that it's important as you're navigating your clients and they're graduating from 1 to 4s into the multi-world to come to a lender, as I say, correct, come with a package that shows they know what they're doing. They're not, we're not trying to kind of be the apex tech of multifamily lending where we're teaching them. We certainly want to see that they're coming with the things that are typical on these types of projects, and that gives a lender like us a lot more comfort to kind of make that educated, I don't want to use the word gamble because we don't gamble, but to make the bet on that developer that they're going to take what they've learned in the previous parts of their lives and use it going forward. And again, so it's preparation, it's staying within your local market, having a tight crew, and knowing what you're doing. And a lender like us will tend to kind of err on the side of working with that developer.
Thank you, Harris. Appreciate that. And in general, it's really building that relationship with your brokers, your lenders. To kind of pivot into DSCR, the 1 to 8 unit or even 1 to 10 unit space, Aaron, would you kind of dive into how the DSCR loan is styled, how it's underwritten, what a lender looks for, and really where that helps you best grow in the market?
Yeah, absolutely. And like I said, we do a lot of DSCR lending. We'll probably do $2+ billion of DSCR lending this year across the entire country. I would say, I can get into those mechanics right now, but there's also a lot of liquidity in the market for DSCR. So Logan, gets its liquidity. We have multiple execution sources. We have the general Wall Street partners that really are securitization outlets. We have insurance fund outlets, and then we also have balance sheet outlets. And we do that on purpose because at any time in the market, and we're seeing a lot of volatility in the market right now, geopolitical issues, other things going on, we want to make sure that if one of those executions exits the market, becomes less liquid in the market, whatever the case may be, we have ample liquidity and executions for our brokers so that you can always maintain that relationship and know that there's really a steady source of liquidity in the market for DSCR. DSCR is a very simple loan at the end of the day. It's just debt service cover ratio, right? So we're just looking at total cost going into that property, pity if you will, and we're pulling out a ratio based on rents. Could be long-term rent, could be short-term STR rent, could be average rents on a 1007 for the area. So it becomes a very simple loan where you're just looking at a ratio. Typically anything 1 to above is a pretty easy loan to get done. It prices pretty well. Anything below a 1 ratio is still possible. We have no ratio. We have low ratio. They're priced for the risk. We are seeing liquidity in the market start to strain at 1 and below ratio DSCR loans. Usually a very quick underwrite, very quick process to get through. One of the caveats where we have issues is first-time investors. We can get that done, but we like to see folks that have some experience behind them and know how to manage property, et cetera. And then also, a lot of these are all in LLCs, but you start getting a lot of layered LLCs or trust. That becomes a little difficult to unwind sometimes. Not that we can't get those done, but those were the difficulty in the market you'll find as a broker.
Thank you, Aaron. And kind of to pivot with the difficulty on the DSCR market or some of the common pitfalls you run into, what would you say are more of the easier deals, like the cookie cutter, bread and butter for a DSCR loan and to grow the investor?
Look, 1 to 8 unit is, certainly 1 to 4 unit is really simple. There's ample liquidity in the market. It really comes down to the value of that property and your DSCR ratio, and that's it. We are seeing some liquidity strains in the 5 to 10 market, if you will. Those loans are still getting done, but you're seeing some hesitant from Wall Street and other funds on those deals. Kind of the same thing, though. As long as you have a good ratio in terms of that coverage, you're in good shape. Again, I think the difficulty comes in when you have multiple partners, multiple LCs, layered legal entities, things of that nature, and then valuation. I mean, to be candid, we are seeing some values soften in different parts of the country. I would compare this year versus last year. I think the percentage of that happening is much higher. So at the end of the day, it's really about the value of that property and the coverage ratio.
Thank you, Aaron. Courtney?
Yeah, I would piggyback off it. I know you asked about the difficulties of it. Well, you didn't ask about the easy stuff. I would say the difficulties is, especially on the DSCR side, is if you see mortgage rates and then you don't have an explanation for those mortgage rates or what's going on and documentation to back that up. And then also probably where we found a little constraint is on the regular DSCR market, if you're trying to finance over 25 properties, then that's when you get a constraint. Luckily, we're backed by a credit manager where you can go into the non-recourse space when you're going above 25 units. But I think those are the two pitfalls you can find in the regular DSCR market.
With those pitfalls, have you found that there's options to kind of work around that with experienced borrowers, or what flexibility would there be to navigate that with?
I think, especially if you see the mortgage rates, it's going to be very difficult if the credit score is coming in under 650. But if you still have a high credit score and you can have an explanation there, I think you can have some type of you can get it from your loan buyer. You probably can get some type of extension for that, and it may be a risk-adjusted price for that at that time as well.
To kind of pivot into the pricing portion, whether the overlays are for credit, have you seen much change in the market from last year to now, and where do you kind of see that market going?
I'll start. I'll let you piggyback off it. As he said, the 5 to 10 unit is very hard to finance on this side. So you do have to see some overlays where there's pricing probably somewhere 50 to 75 basis points higher than your regular DSCR 1 to 4 product. And then also I would say on the entity side is when you have more than 4 or 5 people inside of an entity, it gets very difficult to really nail down who is the true guarantor of that loan and really figure out who is my borrower in this instance. So I think those two things are what we see on that side.
Yeah, I would say that I've never seen more liquidity in this space than I have this year. Mm-hmm. All the executions that I mentioned prior, whether it's insurance, balance sheet, or securitization, there is more demand and liquidity for this product than there is paper. So you have institutions fighting over this paper and competitive pricing, even at the investor level. Certainly, as I said before, the 1 to 4 unit is very liquid, gets a little tighter as you go up. We are seeing, look, our average portfolio of DSCR is a 758 FICO and a 68 LTV. A 760 FICO for us today will get you a rate probably below 6. So you're seeing rates in that institutional space that are as good or better at times than the prime mortgage market. So it's really a good time to be in that space. 35% of our funded loans on DSCR have exceptions. So over a third of every loan we fund has some type of exception on it. So, we're looking at ways to get these things done, be pragmatic, and make a good credit decision. These are not black box type of products.
Harris, did you have
Yeah, I mean, as far as, you asked about pricing, again, this is the zero interest panel, so 0. Because a lot of people here are predisposed and probably in the multifamily world, I was going to flip it back to you, Logan, to kind of understand how the 5 to 9 world is evolving, and that's always sort of one of these areas where there's a lot of demand, there's a lot of overlap from the traditional broker world, and they're coming because perhaps the banks aren't there for those particular deals. It's a little bit smaller. So where do we see that evolving to? Is it becoming more of a captive market that's relied upon? So I think this audience probably sees a lot of that flow.
Yeah, I think the question there is there's always a little bit of a question on the 5 to 8 market as whether it's true resi or is it kind of creeping into the multifamily type markets. So there's always a little bit of crossover in terms of the investor and how they think about the credit risk, how they price for the risk, et cetera. We are seeing a lot of insurance funds that have quite an axe for the 5 to 10 unit, if you will. Although liquidity is a little tighter there, there's still quite a bit of demand in that space that we see, a little less on Wall Street in terms of securitization, things of that nature, but still a very liquid product that you can get done. I think it takes a little more in terms of underwriting and appraisal evaluation and things of that nature. We want to make sure that we have a really solid credit-worthy deal. To be candid, we've been going out to our investors and trying to raise more liquidity around this, because as we look at our book, the 5 to 8 unit actually performs better than any other product we have in our book. So we're trying to tell investors, if you want duration and quality, then this is a great product to have.
Are the metrics different on those deals going in? Are the DSCR's requirements higher?
They tend not to be below 1 in ratios. Obviously, I think there's some other underwriting provisions around that. Most of the time, they do have some type of prepay, so you have a duration play there as well. And we just do not see we don't see much default, if any default, in that space.
Yeah, I would say the reason you see so much demand in that 5 to 20 world, 5 to 10 world is because the banks have pulled back so much. So usually that product is financed by the smaller banks, and now that their liquidity is shut off, now it's coming into the private world, and that's where you see that large uptick in opportunity there for those type of products.
And with the larger amount flowing in, I know a lot of companies are starting with new product in the 5 to 10 space. Are investors pushing back if too much is coming in? What are you seeing there? How's the appetite in general?
Yeah, I think they're careful in terms of how they build their portfolio. I don't see anybody going all in on 5 to 8. I think they want to sprinkle it in at certain percentages of their overall risk layering, if you will. But there's plenty of demand and liquidity out there to get these things done. And we're seeing competitive pricing in terms of secondary and capital markets on this product as well, which tells me that more people are entering the space and there's more liquidity. So, I think it's a space. In terms of credit, I think that I don't see a lot of widening of the credit box this year. This is just my perspective in the standard non-QM market. I think investors have gotten really comfortable where the credit box is. So I don't see it widening, but I do see more liquidity coming in and more demand happening for paper that they feel kind of goes right down the fairway.
And for the credit box not widening, would you say investors are getting stricter, evolving? So not necessarily a stricter guideline, but just really narrowing in and honing what the DSCR loan would look like and what they want to see?
I think they're data driven. So if you don't have the data to back up what you want to sell them, then it's going to be hard to have them widen the box. When I started in this space, we were doing 80% loan to cost on fix and flip. Now you have securitizations that have 100% loan to cost in those securitizations, but it's taking time over time to prove out that fact. And I think we'll see the same thing in that 5 to 20 unit spaces, where as we have 2 to 3 years of data to show the performance history of that, then that credit box will widen in that space.
And by the way, they will widen the credit box. There are opportunities to kind of get outside the lines. But what I'm seeing, especially from Wall Street, is that they're pricing for the risk. So I think they feel like they can price appropriately for the risk today. But, they're keeping the lines fairly tight, I think. And I think we'll see that throughout the year.
What are you seeing in this in terms of loan amount and product type? As I know a lot of investors are starting to grow more into those small loans. Brokers are looking at small loans differently. How can they, build a book of business around this? But what effect are you seeing it have?
Well, I hate small loans, but from an operational standpoint, and I'm the COO, it costs me just as much to manufacture a $100,000 loan as it does a $1 million loan. And I make a lot less, obviously, on that loan through the process. We are seeing, especially in the Northeast, a lot of low balance loans. That 200 to 400 bucket has become really prevalent. I think that I don't see any investor that really has a a negative opinion on it from a credit standpoint. We do see that defaults and the lower loan balances are higher. We see that in our own portfolio. I don't know that that's really come out into the securitizations and the Main Street yet, but we're doing a lot of low balance loans. I think that there are brokers we see in the Northeast that are building business around that product. We price it accordingly, and quite a bit of it in the marketplace right now.
Thank you. Harris, I'm going to give you this one. For small middle loans, what are conversations brokers should be having with their borrowers to ensure that the deal is coming in good, you're not going to run into issues down the line?
Yeah, well, I mean, I think small and complicated is the biggest problem. Small and simple gets done. And as far as messaging to the borrower, I mean, I think that is the message. If you're going to go to a lender like us or any of you guys, and it's small, number one, you can obviously sell the fact that this is a part of a larger portfolio. You're incubating this developer for a future relationship and kind of sell into that. It could be this is the third generation of a family, and this guy's doing his own new thing, and he's going to be growing into that. So, because there's always going to be in our industry, we have varying ages in this room. I think I'm probably one of the older people here, and so it's an industry where the old people don't leave. Right, we always stick around, and there's always young people coming in, and I think that as guys are coming into the business, they have to start somewhere. So that developer's starting somewhere, that lender's starting somewhere, that broker's starting somewhere, and as long as you're not pairing an 18-year-old, no offense, guy doing his first $250,000 deal with a 55-year-old guy who's been in the business for 30 years, that's probably not going to work so well. But I think if you have guys who are kind of motivated to kind of grow together. And know that it's going to be the beginning of a 20-year relationship, you kind of sell that. And then at the same time, let the lender charge you a little bit more. And don't push back so much on that. And, try to make sure that this is not where you're trying out a brand new, legal structure, because it's probably not the best way to do it. So I think that's toward your question, but maybe in the way that I wanted to steer it a little bit.
I would like to just know where these brokers are finding the small loans, because I'm a real estate investor and I can't find them. So, but we sure see a lot of them. And just for kind of pull back the curtain, a large lender like us who has layers and layers of compliance and legal and all the things we have to do, it costs about $10,000 a loan to manufacture it. So back to my comment, I'm doing a $150,000 loan or $1.2 million loan. The economics are a lot different for us.
And so would you say doing the smaller loans is more of a service level loan where you still are servicing it, we're building relationships, but really the goal is to continuously do business with the broker partners and borrowers?
Yeah, we're happy to do them. And as it was said, I think everybody starts somewhere, and I think there's folks that focus on that particular business, especially in the DSCR market. And we're happy to build that with you. Prior comments, I think, understand that little loans are harder to do. They become complex. They default more. So again, if you're trying something new and complicated legal structure and those type of things that were mentioned, I'd steer you away. But you can make a living there.
Thank you, Aaron. Courtney, question for multifamily and more institutional portfolio lending. Where are you seeing that take effect versus like an individual residential loan? Are you seeing more portfolio loans?
Yeah. For us, I would say 80% of our book is portfolio loans, because we just deal with that type of investor. A lot of our investors are building, and then they're going to do a lease-up bridge, and then they're going to do a refi out if it's a longer-term 5-year or 10-year IO product, or if they're just doing, different segments of the market where I'm going to finance 5 to 12 houses in a portfolio loan. And so usually those loans, I would say, over time perform better because they're cross-collateralized. So I like seeing those portfolio loans because they cross-collateralize and usually have a higher debt service coverage ratio, and then versus the single loans. I'm from the Southeast, so we do manufacture a lot of small stuff because that's evidently what's in our backyard. But we do like seeing the portfolio loans because they do perform better, and then you do have a higher credit bar behind that.
Yeah, I mean, I was just going to add, we start talking about portfolios and kind of planned urban developments, PUDs, townhouses. I think that's a kind of a good opportunity to kind of take this product of this 1 to 4 fix and flip world, which tends to lean a little bit more into loan to cost, some of the metrics, and kind of steer it away from the commercial multifamily world where it's a little more conservative when you're able to have these types of deals with individual tax parcels that are for sale townhouses, like a lender like Bayport or you might be able to craft a total loan profile that may come up to a loan amount, say $5 to $10 million or more, but it could be individual loans that are on the individual units. So you're saving your borrower from having to worry about release provisions, how he's going to access his equity because you have individual loans. You sell a townhouse, you pay it off, you pocket the profit, and you may get a higher loan-to-cost loan as a result of going through that process versus doing a one blanket loan as a 15, 20 unit. And that's where there's some economies of scale to go into the 1 to 4 market. So we kind of play in between those two and kind of see where a particular deal may be better served by steering it into a 1 to 4 product that has those advantages. Certain times it doesn't work because if you haven't split the tax lots up yet, you can't really do it that way. But potentially on the acquisition, you do it as one loan. Then as you get your splits, then you can reevaluate and restructure your loan. So that's kind of taking the 1 to 4 product in your toolbox and using it for your clients who are not really thinking that they're in that world, but you put them in that world and they get a better product.
And so that's really we're growing the business of the DSCR for the borrower. Let's pivot to where can the broker really grow their business and make money in the space? Aaron?
I mean, we actually have a really large business development unit at Logan, and they talk to a lot of brokers. I would encourage you to contact us and get in touch with them. They do webinars, they come out, they do trainings. But there are a lot of opportunities within almost every market. There's real estate clubs, there's investment clubs. I think I call them influencers, your CPAs, other folks that work around the real estate market. We have brokers that have just absolutely have been prime brokers in the past, have built their entire career now around business purpose DSCR. They operate in these circles, the circles like we see here at this conference. And we find in most communities there are these different types of real estate investment clubs, things of that nature, where you can, it doesn't do any good to fish in a pond that has no fish, right? So go where the fish are and sell your goods. And that's what we're trying to help brokers do.
Yeah, in the investment world, if you look at data, CoreLogic data, the most real estate investors that are out there that operate in the 1 to 4 space do between 3 to 5 transactions a year. Like that is 80% of the market, not your guys that are doing 100, 200 houses a year. And so what I see from the brokers is they're able to tap into that space. And a lot of times they're doing it by doing creative marketing online or online advertisement to be able to get those people into the door. And they're able to say, hey, I'm going to spend $10,000 to $15,000 a month on marketing, but it's going to bring me in somewhere dollars of $100,000 to $200,000 when it comes in for the DSCR. If you're making somewhere between 1 to 2 points on a loan, so I think that's where you're doing it because it's a constant marketing effort and educating those borrowers on that product. But I think it's so much opportunity out there because of that's what you see in the space, and it's prime opportunity because usually people were going to Fannie and Freddie to do those loans, and now they can't because of the pullback in that market.
By the way, the number one profession in America that does DSCR loans are realtors. So realtors are out in the market, they see property, they see deals, they know the space, and there are more realtors doing debt service cover loans than any other profession.
I would also add that, in this, again, we're kind of going back and forth between the 1 to 4 fix and flip DSCR world and the multifamily world. I think in this space, because brokers want to get paid, and the interesting thing, at least the way it is with us, probably with you as well, if a loan comes in, whatever day of that month, trust me, there's pressure on that originator or processor or whatever to get that loan closed by the end of the month. and I think that's a very powerful tool for brokers who want to know that they can have a reliable source of cash flow to kind of maybe supplement some of the other earnings they've got from the larger loans that have a longer lead time. And if you can kind of infuse your book with these smaller loans that are that again, that DNA is quick moving, get them in, get them out, close it, move on. That's a very powerful tool for the broker to help have a more predictable flow, cash flow. And I think that's where we see some of our brokers really take advantage of the product.
And so a lot of residential investors are looking at whether they should go direct to lender or have the broker involved. Where are you kind of seeing the shift of that, and where can the broker really build the value to ensure they're not indispensable in that transaction?
I see a considerable shift from retail to TPO, right? I think we've seen that in the non-QM space for some time. I think it's really accelerated over the last couple of years. I think brokers are the way of the future, especially in this space. It's what I would recommend a friend to do if they wanted to get a loan done. I think as a broker, you can really build an annuity stream around this type of business, because you have an investor that's going to potentially do multiple DSCR deals over time as they build their portfolio. You're a good broker, a good partner, a good business person, that they are going to use you, obviously. I would advise brokers, I tell people all this time, do good business, know your deal, you can't be everything to everybody, don't try to be that. Find good people to work with, know your deal. Don't let us figure out something 3/4 of the way through underwriting the deal. Understand what the deal is, what the needs are, and how you get it done. And I really think that this is a space that you can just grow and create an annuity type of income stream in.
And kind of creating that relationship, and your brokers are building it with lenders, and then they're also on the borrower side, but it's kind of their ability to commit to the execution of the loan. So it is really through the full transaction. Courtney, where have you seen either borrowers kind of come directly to you, or do you tend to have more of the broker business as well?
Our business is split 50-50. And I would say I would rather have more broker business, good broker business, because my cost of acquisition of that client is a lot cheaper when I go that route as well. And so we see it 50-50, but we will never circumvent the broker to be able to go through that relationship. And like he said, how to grow their business is a true TPO, where you either have your own warehouse line, or we can just close it in a white label manner that you have, and we're ultimately the servicer behind that loan. But we want to grow the business either way, and we will always educate the broker and the direct borrower on the loan product, what are the covenants, and what are the hiccups there as well.
For the brokers in the room, what is one thing, and I'll kind of go down the line here, what is something that you'd recommend that they start today or tomorrow to really grow their business, whether it's relationship-wise or even making sure that the deals they're bringing in are good loans? Not only is that to guarantee the execution of the loan, but on the investor side is doing good business keeps the business going, and we're here for a long time, not a short time, so doing good loans is important.
Look, as a broker, I think you should choose your lender carefully. I'm in more of the traditional non-QM space. I think you should look for a lender. We've talked through this conference that, having different execution strategies in the market as the market ebbs and flows is really important. You don't want to have a client that you're doing tremendous business with, and all of a sudden you can't fund a loan, or everything stops in the process, right? So I think really having a relationship, doing your homework, and understanding who your lenders are. I would really tell you, pick 3, 4, 5 good lenders. Stay with them. Don't go out and shotgun the market. I just don't think it's going to be a good relationship and a good experience for your client at the end of the day. And then as we've talked about before, this is all about relationships, and you can really build a kind of an annuity business. You know, do some homework. Understand who you're, you know, if you get out and you start getting into the investor community and you attend these things like this, and you attend investor meetings and real estate meetings, and you're with CPAs and divorce attorneys and all these other places that you can find business, do a little bit of research on who you're doing business with. I understand that you guys eat what you kill and every deal matters, but I think if you're going to build a really solid relationship-based business, understand who your client is, understand who your exit strategy is, and I think you can really build a nice business off of that for a long time. Where you get in trouble is when you got somebody that's a bad actor on the buy side, then you're dealing with a lender that may run out of funds, it could be a million things that happen. So I think having that, if you're serious about your career, tied down up front, you're going to have a much happier, longer, and more successful career in my view.
Those are great points. Most people here are pretty seasoned professionals, so they're not going to take advice from me. But I would say, with respect to how we work, I would just encourage come to our offices or your offices or whomever. We happen to be in Great Neck and Midtown, so if you want to do that too, and meet with us or you and get to know people, see the whites of their eyes, develop the interpersonal relationship. This is a very our world right now is very, disconnected from, person to person, and there's a lot of great efficiencies with AI and all that good stuff. But at the end of the day, when you're sitting in the room with decision makers who literally make decisions on loans in that room, get yourself into that room, have them know who you are. So when you're picking up the phone, they're saying, "Oh, yeah, we met Bill. He came in with his developer, good guy, brought him into the office," and that really means a lot because we're all so distracted by the day-to-day, and when we're able to kind of associate people to faces and have that relationship, it really is so unquantifiable and so valuable.
To grow your business, I'll give you something that's different from them. I agree wholeheartedly where you need 2 to 5 lenders in your Rolodex to make sure you go to and understand their product matrices. But I would also say, as a broker, to really dominate your market on the fix and flip, new construction, and DSCR side is relationship. So I would say if you want to cast a net, choose 2 to 5 local markets that you want to be in and launch digital advertisement into those markets and then own those markets. And that way you can build your book of business over time through those markets.
With the market, would you say that becoming very knowledgeable in 1 to 4, 5 to 10, so multi-unit, small business, should you narrow your field first and then grow from there, or would you keep an open mind?
I would keep an
business
open mind.
to business.
Keep an open mind.
Yeah, but I tell people, I agree, but I would tell people all the time, we have, in just our non-QM space, we have a full sheet of products that you could use, right? If you look at the data across the market, and we do that every day, we look at OB data that shows us where locks come in every day. 80% of the market, 80% of the entire non-QM market is made up of DSCR and bank statement loans. So if you become an expert on DSCR and bank statement loans only, you're going to cover 80% plus of market needs in my space. So you don't have to boil the ocean. If you can become an expert, and people buy from people they perceive as experts, as product specialists, if you can master those, and then you can branch off from there if you need to. But I also think as you start getting into more exotic products and things of that nature, you take on a risk of execution. You're going to have more loans fall out, which affect your broker relationship or your customer relationship. So I think those are all things to consider if you're really building a nice book of business.
To circle back to more of like the RTL style loans. So where we covered a lot of DSCR for rehab, fix and flip, bridge, where are you seeing the trends for that need of the bridge loan and into permanent financing?
A lot of time is that transition loan where, hey, I don't want to rent the property out, or my rehab RTL loan is ran out on the maturity side, and I need an in-between loan to figure out if I'm going to rent the property or list it for sale or have time to need it for sale. I think a lot of times we have no problem doing those loans. Usually you see leverage somewhere between 65, 75% cash out on the high end. Very risky in my book to take the equity out on the book on a short-term bridge side. Usually we will originate somewhere between 65 and 70, but we have no problem doing those loans as long as we understand the business plan. And then also, if I get a payoff, and making sure the payoff doesn't have any lates past that you had with your previous lender. And so I think that is the red flag, where if you had 2 or 3 lates with that lender, 99% of the time we're going to turn down that loan. A maturity default we can deal with because we understand, hey, you're trying to figure out what you need to do and the interest rates is going up. But when you have a late for not paying the bills and you have that client that's have a late, it's going to be really hard to be able to get that loan done. Or if you're going to get that loan done, it's going to cost you a lot of money to get it done.
Harris, do you have anything to add on where you're seeing?
Yeah, just because the national trend has been very difficult to get people with low interest loans to move out of their houses. That's a kind of a major macroeconomic issue. We see, especially in urban areas, the opportunities to purchase properties that have a better, higher, and best use. A 2-family that could be torn down and built into a 10-family, or something that is allowable within the parameters of zoning, and or working with local municipalities, sort of taking an existing property that might be in the 1 to 4 space, but transitioning it, either as a tear down, ground up, or adaptive reuse into, more units, more square footage, and a different development. Those types of projects are kind of transcend some of these numbers because you might be overpaying for that particular house, but if you're able to have it re-entitled and expanded into a higher and best use, well, that acquisition price is a rounding error if you're able to kind of do more. So we kind of see the world of, call it RTL, just because that connotes 1 to 4s, kind of merge into the world of multifamily because the end use is going to be a larger product. And that's kind of where we see an effective strategy in what the market has to offer right now. And we kind of enjoy that. And we can actually lend into a typical RTL day one strategy to give more leverage at close, but then actually transition into a multifamily construction project, which is slightly over-levered day one, but let the developer put some equity in via a foundation or demo, excavation, and come back to us for the vertical. So RTL kind of overlaps into multifamily, which ends up kind of solving some of the problems of having to overpay for an asset.
Something we haven't touched on, it just came to my mind. I'll just take 1 minute if you don't mind. As you're a broker, if you just look at the overall space and kind of where the country is today in terms of entrepreneurship and people using non-conforming loans and lending to get things done, a point that you just made reminded me of this. I kind of sat in that same boat. I'm an empty nester now. My wife and we live in a 5,800 square foot house. I figured out I had a bathroom upstairs last week I didn't know I had, and I'm financed at 2 1/8. I'm not leaving. Ever, probably. Yeah. But I want to take my money and I want to go form LLCs and I want to buy investment property. And I've been doing that. And my friends have been doing that. As of November of last year, there was 5.8 million new business applications filed in America. That's almost at COVID levels. So we're seeing a real shift in the socioeconomic market of entrepreneurship, business formation. I think the gig economy, people work several jobs, they do different things, they do something entrepreneurial. So I think we're seeing the overall non-conforming lending space grow. I think we think it's about 10% of the overall prime market. We have projections in the next 5 years it'll be up to 15, 16. That becomes a pretty large market, a pretty great opportunity for you as a broker. Not to mention on the DSCR side, with the great new tax bill, or what is it called, the grand tax bill or whatever, you get 100% bonus depreciation under certain circumstances as an investor. That's a game changer. I'm buying as much property as I can possibly buy under those rules. Because of 100% bonus depreciation that I get on that, and investors are seeing that, and we're really seeing an explosion in the business purpose space and alternative lending space altogether.
But what product are you using to tap into that equity?
That's the DSCR product that we primarily use, and you know, whether you're there's some tax carve-outs that you should learn in the new bill that are really advantageous to investors, and I think you're seeing a lot of folks, good or bad, that haven't been investors in the past, entering that space.
Thank you, everyone. And for us covering the small to middle market loans, before we wrap up, I want to give everyone a last chance to make any last comments, because I know we're coming to an end here on the panel. Let's start with Courtney. Do you have any last comments?
I would say just own your market, be educated when it comes to your loan products, and then build relationships with your clientele, and that's how you're going to get business done.
Thank you. Harris?
The New York Mets.
Your favorite?
That was from the last one, but you're asking for World Series predictions, so New York Mets. Okay. And then on the business side, again, selfishly, I'll promote the fact that we're open for business with our own capital for developers building middle market multifamily projects size $2 to $10 million, going from the ground up, make construction, adaptive reuse. Very user friendly with brokers, keeping the relationship sticky throughout the process and then post close. And we also will cover the RTL and DSCR space. Although we have a great partner with Logan, who typically sees most of our deals anyways, and they're fantastic to work with. A little bit of a plug. And yeah, we're very excited about 2026.
Thank you, Harris. And he's the one you're supposed to go to for the zero interest loans?
Yeah, zero interest loans, but not at Bayport.
I flew in last night. I've been so impressed by this show and this gathering. What I've taken away today, I'm impressed by the attendance. I've talked to, it feels like 1 million people today. Everybody I've talked to seems like a good citizen. It seems like we just have a great business community here. We're very honored at Logan to sponsor and candidly, from my perspective, just to be part of this business community. I'm really thrilled about that. I couldn't be happier about this opportunity. Look, we want to be a relationship lender. I got several account executives, my best account executives here today. We have a booth up towards the front. Come by, talk to us, and we want to help you build your business. That's really it.
Thank you, Aaron, Harris, and Courtney. Really appreciate you guys being here today at the ReFinance Summit, and thank you everyone for joining.